I'm going to tell you whether you should invest your hard-earned cash into a UK utility stock called National Grid, and which kind of investor it would be most useful for. Also, remember, the most popular comment suggestion down below will be the next stock I do a stock analysis on, so make sure to put your suggestions down below. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please seek a licensed professional. National Grid is a multinational, multi-utility company operating in the UK and Northeast United States. And it transmits and distributes gas and electricity across its infrastructure in the UK and the US. Well, and has a natural monopoly. Lately, National Grid has fallen into the radar for investors. Whilst it was always quite a popular stock for income seekers, because it had a decline of 15% over the course of a week, it's now seen as more of an opportunity. I'm going to elaborate more in this video. And this is due to OFGEM, the Office of Gas and Electricity Markets, and they had proposed a deal that would cut the revenue for National Grid in half, which inherently impacts the shareholders and their returns that they could get from this, effectively meaning that the dividend might not be sustainable, hence a large sell-off. They'd also pass through ex-dividend date, also equating to that. This does present some risk, as this was a safe income investment, but the future could deem otherwise. And please make sure to drop me one of these for the YouTube algorithm. Despite the recent sell-off, the price to earnings ratio of National Grid is still on the higher side. The price to earnings ratio is currently 24.5 times, which is very close to the 5-year high of 26.4 times. And this is still higher than its industry of 19 times, and subsequently the market of 15 times, which suggests that National Grid is traded at more of a premium. Investors believe more in this stock compared to other utilities in the sector, and therefore it has a greater popularity amongst them. However, when looking at price to book, you'll actually notice that the price to book ratio is lower than its industry. So they have 1.6 times versus the industry of 1.7 times, suggesting that based on their assets that they own, they could be considered undervalued. With this in mind, I think it's fair to assume that they aren't exactly a value stock, but there could be an opportunity present here right now. And this is especially an opportunity when you consider that their beta volatility is 0.13 compared to the industry of 0.96. This means that if the market drops 10%, National Grid might drop 1%. That is some very, very defensive volatility right there. And that's why a lot of income seekers like it. National Grid currently has a dividend yield of 5.38 and a dividend frequency of biannually, typically paying in January and August each year. However, they do have a payout ratio on the higher side of 132%, which is deemed a lot riskier, and currently their earnings do not cover their dividend, and therefore they're either going to have to take it out of their cash reserves to pay their shareholders a dividend, or they're going to have to get into more debt. I suspect this is due to less energy being used during the lockdown period a few months ago, and this applies to the United States and the UK. Factories were very likely to have been shut down or in lockdown, therefore not using anywhere near as much power. And citizens, whilst yes, there'd be more people at home, I don't think that would generate as much power as an operating factory of loads of different machines. And also, US debt collections were suspended, and I believe that maybe more people are missing payments, and therefore they're getting a little bit more out of control, and that's an income stream or a revenue source that they're currently not getting anything from. Despite the grimmer outlook on the dividend, they have got an amazing dividend history. And over the last 20 years, they've managed to grow it each and every year. And in fact, over the last 10 years, they've managed to grow their dividend by a compound annual growth rate of 3.5%. Yes, this is lower than other stocks, but in its industry, it's quite impressive. 3.5% beats the rate of inflation set by the Bank of England as a target by nearly 2 times. And I think, yes, it's beating inflation, and it's a safe, reliable income stream that dividend seekers could likely appreciate in times of uncertainty, such as a black swan pandemic event that we are currently experiencing once in 100 years. With this in mind, they still managed to grow the most recent dividend by 2%. They are currently going to be struggling for their payments of dividends, but I don't think this means they're going to cut it or suspend it anytime soon. Although I am a little concerned about the safety of the dividend if the OFGEM proposal isn't changed or negotiated in any way, as that does represent a serious threat to their amount of earnings they can generate from 2021 onwards. And if you've enjoyed the video so far, please consider subscribing for my weekly portfolio updates, stock picks, and analysis in the UK. After all, it is free. Thank you. Whilst this is a utility company, I'd like to look at their effectiveness of using their cash and shareholders' equity in order to generate returns within the business, and therefore see how much they could potentially grow as well as increase the share price of their stock. Unfortunately, their revenue and earnings have been relatively stagnant over the last 5 to 10 years, and in fact, in the last 5 years, they've managed to annually average a minus 1.2% growth on their earnings, effectively meaning that they're slowly losing money, which isn't great if you want this stock to appreciate in share price and give you healthy capital returns. But then it is a utility company. You can't expect too much of it. And this is backed up by its return on equity of 6.5%, which is lower than its industry of 8.6%. But utilities typically don't generate that much returns on the cash, and rather they are a staple, a necessity, and typically they would make a majority of their money throughout like government grants and other things. So therefore, we can't really expect them to make high profits from this. And it would be very foolish to expect much capital appreciation from them. However, the biggest risk to a utility company, in my opinion, is the idea of them going bust or bankrupt. And National Grid certainly could see this. With their balance sheet, their balance sheet isn't that strong, and their short-term assets are outweighed by their short-term liabilities as well as their long-term liabilities. However, they do have a lot of long-term assets which completely outweigh this, but you don't really want to be liquidating your long-term assets to pay off debt. And whilst they've managed to reduce their debt-to-equity ratio by 75% in the last 5 years, this is mainly by increasing their overall equity, and the debt level has sustained at the similar amount. And it is concerning because it's not very well covered by their operating cash flow. Currently, they've got around 14.7%, effectively meaning that it would take 6.7 years if they'd put all of their operating cash flow into paying off the debt. However, you wouldn't expect this to happen. It's very unlikely, but it does add some concerns because this debt will be long lasting in the company. It's very likely they're going to have to continue leveraging themselves in order to see fairly moderate returns. And this is compounded with the idea that their revenue could be slashed in half from 2021 onwards. It really doesn't present much of a revenue growth positive for the future. Although I really don't think they're at risk of going bankrupt. Not only are they well managed, I do feel that they are almost too big to fail. And in the United States, yes, there could be a situation where they fail and therefore other utility companies buy out their assets. But in the UK, I very much believe that the government would bail them out, as they are so essential in the transportation of our electricity and gas across the country due to its high importance in infrastructure. At around 900 pence per share, it's right in the middle of its 52-week highs and lows. I personally believe that this is a great price to start investing in the company. If you'd have owned this stock in the last 5 years, you would have seen returns of 37.6% with dividends reinvested. And a lot of this has been chopped off due to the recent share price drops. And I very much can see this trading at 1,000 pence per share. It has, however, outperformed its industry and the market. However, I believe that this stock fits better in income portfolios and for those with a lower risk tolerance. So I'm more or less suspecting that those that are close to retirement would very much like to invest in this stock if they have not already, as it provides a healthy dividend yield, slow growth rate, but consistent, reliable income. And that just doesn't fit in my portfolio where I'm looking for more high risk stocks. However, in the future, I certainly don't rule out the idea of years down the line, potentially investing in this company once more. And if you're interested in my boohoo stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. See you Thursday at 4 PM with a nicer shirt.